Breaking news. Ram just lit a fire under the U.S. auto industry. Shoppers are stunned. Dealers are panicking. And rivals? They're scrambling. Ram has just slashed prices across its lineup, triggering one of the most aggressive pricing shakeups we've ever seen. From showroom floors to Wall Street boardrooms, this bombshell has everyone asking, what's happening to America's truck market? Stick around, because in this video, we're diving deep into Ram's shocking move, what it means for truck buyers, how Ford and GM are reacting, and what this could signal for the future of the U.S. auto industry. In a move that has sent shockwaves through the American auto industry, Ram has just unleashed massive price cuts across its entire truck lineup, and it's not just your typical end-of-year clearance sale. These are deep, strategic price reductions that are unprecedented for a major U.S. truck manufacturer. The Ram 1500, long celebrated for its luxury-grade interior, powerful Hemi engine options, and workhorse durability, has suddenly become one of the most affordable full-size trucks on the market. Base models are now being offered at prices lower than some mid-size competitors, while high-end trims like the Limited, Rebel, and Laramie have been dropped into pricing territories that used to be reserved for mid-tier pickups. According to dealer reports and leaked internal memos, these cuts range anywhere from $6,000 to over $12,000, depending on trim, region, and dealer participation. Some dealers are even offering 0% financing options and additional loyalty incentives on top of that. The effect is seismic. It's not just a discount, it's a declaration of war. Ram has lit the fuse on a pricing war that threatens to ripple across every segment of the U.S. pickup market. At first glance, slashing prices might seem like desperation, but this is actually a calculated strategy born out of necessity and long-term vision. Ram, part of the Stellantis empire, has been under immense pressure in recent quarters. Inventory levels have surged, particularly in the light of slower-than-expected EV truck adoption and cooling demand for high-price models. Add to that a backdrop of rising interest rates, strained consumer credit, and tighter lending standards, and the conditions were ripe for a market shakeup. Ram is staring down two crises: declining sales momentum in its gas-powered lineup and the uncertain reception of its upcoming electric models. But instead of waiting for the market to adjust, Ram took a bold first step to reset consumer expectations and stimulate demand, especially among price-sensitive buyers who've been sidelined by affordability issues. Think about it. By making the Ram 1500 far more accessible, Ram is repositioning itself as not just a premium truck option, but a volume mover, an everyman's truck during economic uncertainty. It's also a tactical attempt to keep their vast dealer network healthy and liquid while waiting for the Ram 1500 REV, their highly anticipated electric pickup, to gain traction. So while this move may look like a fire sale, it's actually a shrewd effort to reshape Ram's market identity before the EV storm hits full force. The reaction from competitors like Ford and GM has been one of stunned silence, at least publicly. But behind closed doors, it's a very different story. Ford is already grappling with its own issues, such as rising costs in its EV division, slower F-150 Lightning sales, and a looming identity crisis over how to balance gas, hybrid, and electric truck offerings. With Ram undercutting them so aggressively, Ford now faces the real possibility of losing market share in both retail and fleet sectors. Ford recently tried to revamp interest in the Lightning by offering price reductions and better lease terms, but those efforts now seem tepid compared to Ram's full-blown price blitz. GM is in a similar bind. The Silverado 1500 has remained competitive, but it hasn't lit the market on fire, especially with GM pushing hard into electric territory without fully solving its combustion engine challenges. And while GM is rolling out new trims and software updates, it hasn't taken drastic pricing actions yet. Toyota's Tundra, while not a top seller, has gained traction recently thanks to its hybrid options and quality perception. But now, with Ram offering full-size capability at mid-size prices, Toyota may have to rethink its long-term pricing strategy too. Ram's move has essentially forced every other truck maker into a corner. Cut prices and lose margin, or stand firm and lose volume. There is no third option. Let's talk about the real winner here. You, the buyer. Ram's price cuts have opened a rare window of opportunity, especially for working-class buyers and families who've been priced out of the full-size truck market. For the first time in years, you can walk into a dealership and talk price without being steamrolled by inflated MSRPs or loaded trims that push you above $70,000. Right now, it's possible to score a Ram 1500 Bighorn or even a Rebel trim with thousands off, low-interest financing, and cash incentives stacked on top. If you're trading in a used vehicle, dealers are far more willing to negotiate aggressively, especially as they try to move 2024 inventory before 2025 models roll in with potentially higher MSRPs. And this pricing pressure won't just stop at Ram. If history is any guide, competitors will eventually be forced to respond, which could spill over into SUV, crossover, and even electric vehicle segments. With used car prices also softening and the Fed hinting at rate cuts later this year, the market could become even more favorable. Simply put, we're entering a potential buyer's market for trucks in 2025, and Ram just pulled the trigger to start that cycle early. If you've been sitting on the sidelines, now may be your moment to make your move. But here's where things take a darker turn. While consumers might celebrate these price cuts in the short term, some analysts are ringing the alarm bells about what this truly signals for the auto industry. Ram's aggressive pricing is not just about market share. It could be a symptom of a deeper, systemic unraveling within U.S. auto manufacturing. Stellantis has already struggled with labor strikes, international trade tensions, rising production costs, and an EV strategy that's seen multiple delays. By slashing prices this dramatically, they may be signaling that demand just isn't there anymore at current price points. In other words, the market is rejecting $70,000 trucks as the norm. Combine that with surging consumer debt, car loan delinquencies at a 10-year high, and supply chain overstock, and you get a recipe for what some call the deflationary spiral, where automakers are forced to slash prices to move units, dealers lose margins, and resale values collapse. It's the exact opposite of the chip shortage boom we saw during COVID. If Ram's price drop becomes the industry standard, we could be witnessing the beginning of a major price correction across the board, one that could shake the foundations of how vehicles are priced, financed, and valued in America. While buyers are celebrating and Ram Corporate is pushing hard for volume, dealerships are stuck in the middle of the storm. On the surface, price cuts mean more foot traffic and faster-moving inventory, but it's not all good news. Many dealers are sitting on large inventories they paid for at higher wholesale prices. When Ram slashes retail prices, dealers are left holding the bag, sometimes selling trucks at a loss just to meet volume targets and avoid aging inventory penalties. Some dealers are offering wild incentives like free accessories, extended warranties, or steep trade-in bonuses just to sweeten the deal. But behind the scenes, there's real concern. Dealership profit margins are shrinking fast, and some fear this is the beginning of a race to the bottom. If the manufacturer keeps cutting prices and consumers expect even better deals, the entire dealership business model could become unsustainable. It's a high-stakes gamble, and not every dealer will survive it. This move isn't just shaking things up in the U.S. Global truck markets are watching closely. Ram's pricing move could have ripple effects in Canada, Mexico, the Middle East, and Australia, key regions where full-size pickups are growing in popularity. With Ram aggressively discounting in the U.S., Stellantis may soon be forced to adjust international pricing strategies to avoid price disparities that hurt global competitiveness. Meanwhile, foreign automakers like Toyota, Nissan, and Hyundai are evaluating whether they need to ramp up their North American production or revise plans to enter or re-enter the full-size truck market more aggressively. And let's not forget the Chinese automakers. Brands like BYD and Geely are quietly eyeing U.S. market entry. If they see American brands slashing prices, they might push harder to enter with cheaper, fully loaded alternatives, especially if U.S. companies look weakened or desperate. Ram's bombshell may not only be a reaction to market conditions. It could also be an attempt to beat foreign challengers to the punch. Here's the elephant in the room. What does this mean for Ram's upcoming electric truck, the 1500 REV? Ram's EV truck is supposed to debut as a tech-forward, premium product, and yet now the company is training buyers to expect deep discounts and low prices. That's a branding conflict. Will customers pay a premium for Ram's electric future after being spoiled by fire sale pricing on gas-powered models? Ram now faces a tricky challenge: how to transition into the EV market without undermining its own brand value. On top of that, the 1500 REV is entering an increasingly crowded field, with Ford, Tesla, Rivian, and GM all fighting for slices of a shrinking EV truck pie. By slashing gas truck prices, Ram may be conceding that the electric future isn't arriving fast enough, and they need to buy time. But that time comes at the cost of margins, branding, and long-term positioning. Can they really pull it off without cannibalizing their own future? That's the billion-dollar question. Some industry insiders believe Ram is doing something bigger than a price drop. They're pressing the reset button on the entire brand. For years, Ram has positioned itself as the luxurious yet rugged alternative to Ford and Chevy. But in a world of skyrocketing inflation, high interest rates, and affordability crises, luxury might not be the selling point it once was. By making high-end trims more accessible and repositioning their brand as value-packed and work-ready, Ram could be building the foundation for a new era. This might also be Stellantis testing the waters for direct-to-consumer sales, simplified configurations, and more aggressive online pricing models. What Tesla did to the EV market, Ram could be trying to do for gas-powered trucks. Cut the fluff, simplify the process, and flood the market before competition catches up. It's a long-term strategy that sacrifices short-term profits for long-term dominance, if they can survive the storm. The financial markets haven't ignored this bombshell. Stellantis shares took a hit in early trading after the news spread, with investors wondering if this move was born out of desperation or smart disruption. Some analysts are concerned that plummeting margins could strain Stellantis' North American profits, which fund a large part of their European and South American operations. Meanwhile, truck-focused forums, Reddit threads, and YouTube comments are lighting up with debate. Some buyers are thrilled, calling it the best deal in years, while others worry it could signal value collapse, where today's buyers lose resale value as prices tumble even further. Social media sentiment is mixed, but one thing is clear. Ram has everyone talking, and that might be the point. Whether it's fear, excitement, or confusion, Stellantis has injected energy into a market that was going stale. It's risky, but it's loud. And sometimes, that's enough to win attention in a crowded field. One of the least talked about but most impacted groups by Ram's pricing bombshell is the commercial fleet buyer. Think construction companies, utility providers, delivery contractors, government agencies, and small businesses, many of whom rely on buying multiple trucks at once. Until now, the high cost of trucks, especially full-size models with adequate towing and hauling capabilities, has been eating into operating margins. But with Ram slashing prices, fleet managers are suddenly rethinking their purchasing plans. Instead of settling for stripped-down base models, many can now afford mid-tier or even premium trims with better technology, improved safety features, and more reliable powertrains, all for the same budget. That means Ram could see a huge uptick in fleet sales, a category that's vital for production volume and long-term brand visibility. If Ram can become the go-to truck for small business fleets, while Ford struggles with hybrid production and GM focuses on EV pivots, they could quietly dominate a segment that often gets overlooked in flashy consumer marketing. Here's a chilling possibility. What if Ram's move becomes the domino that tips the entire U.S. auto pricing structure into collapse? For the past several years, automakers have grown used to consumers accepting ridiculously high MSRPs, limited inventory, and inflated dealer markups, especially during the chip shortage. But now, with Ram openly defying that norm, it sets a precedent others may be forced to follow. And once consumer expectations shift toward lower prices and better deals, it becomes very hard to push those numbers back up. This is especially dangerous in a fragile economy, where even modest interest rate hikes make car loans harder to afford. Once multiple brands are forced to drop prices, the perceived value of new vehicles drops across the board. That affects trade-in values, used car resale markets, and even automaker stock prices. In other words, Ram may have just pulled the first thread on the sweater, and the entire pricing system could unravel. If that happens, it won't be a race to win. It'll be a race to survive. Let's address a trend that's been building for years: the luxurification of pickups. Ram, Ford, and GM have all spent the last decade turning their trucks into rolling mansions, with leather seats, 18-speaker sound systems, panoramic roofs, and massive infotainment screens. But now, that market segment is facing a brutal reality check. The buyers who used to happily pay $70,000 to $90,000 for luxury trucks are either stepping back due to interest rates or shifting toward SUVs and crossovers with more versatility and better gas mileage. With this pricing reset, Ram may be admitting something few want to say out loud. The luxury pickup bubble has popped. The market has grown tired of endless price hikes for trim levels packed with features that go unused. This move might represent a new shift, away from overspec trucks and back toward value-focused, work-ready machines. In many ways, it's a return to Ram's roots, and a signal that trucks may finally be for the people again. If this price-slashing gamble pays off for Ram, it could trigger a brand-wide revolution inside Stellantis, the parent company that owns Chrysler, Dodge, Jeep, and Ram. Jeep is already under fire for overpriced models that aren't selling, while Chrysler struggles with identity and direction. If Ram's deep cuts lead to sales spikes, you can expect similar pricing pressure to follow across other Stellantis brands. Imagine the Jeep Grand Cherokee or Dodge Durango getting massive price cuts to match Hyundai or Kia. It would force rivals to react fast, and it could be a last-ditch effort to keep Stellantis relevant in the U.S. market, where it's been losing ground for years. In this sense, Ram's move may not just be about trucks. It may be the beginning of a new pricing philosophy across an entire automaker conglomerate. But if it fails, it could bring down the rest of the house with it. You may be cheering about price cuts now, but what about your truck's value next year? As new truck prices plummet, used truck values will likely fall too, especially for lightly used models from the last 1 to 3 years. That means if you financed a Ram 1500 recently at $60,000, and it's now selling new for $48,000, you're underwater on that loan. Negative equity becomes a big problem, especially if you plan to sell, refinance, or trade in soon. It also creates headaches for banks and lenders, who now face higher risks on auto loans backed by declining assets. This is how the auto loan bubble could begin to burst. For smart buyers, it might be time to buy cheap, pay cash, or finance wisely. But for those caught in long-term loans on inflated trucks, this could be a financial trap. It's the hidden downside of a pricing crash. When values drop, financing gets dangerous. Beyond pricing and sales numbers, Ram's move reveals something deeper. Consumer psychology has shifted, possibly forever. During the pandemic years, automakers got used to customers paying top dollar, begging for inventory, and accepting markups. But now, consumers are more cautious, price-sensitive, and unwilling to accept inflated costs without questioning the value. Ram's price cuts reflect an acknowledgement of that reality. Buyers want transparency. They want deals. And most importantly, they now expect prices to drop, not rise. That psychological shift may be the most dangerous threat of all to legacy automakers. Because once trust is broken and value becomes a buyer's expectation, not a bonus, it's nearly impossible to go back to inflated pricing models. Ram's gamble could be the beginning of a permanent realignment in how Americans shop for trucks and how brands price them. There's another layer to this price drop that's more political than economic. Ram, an American-born brand, is making a bold move at a time when public sentiment is turning against sky-high car prices, corporate greed, and overseas manufacturing. With the U.S. election season heating up, and both political parties talking tough on inflation, made in America, and restoring middle-class affordability, this pricing shift might not be just about sales. It could be Ram trying to reclaim its blue-collar image and align itself with populist themes like affordability, self-reliance, and working-class values. This move may win over buyers who felt priced out of the market. It may also be Stellantis signaling to Washington and Detroit alike, "We hear you. We're taking action." And if Ford and GM don't respond in kind, they could find themselves losing not just market share, but patriotic goodwill. Let's not forget Ram's parent company, Stellantis, was deeply impacted by the 2023 United Auto Workers (UAW) strike, which led to huge increases in labor costs across its U.S. plants. At the time, Stellantis committed to higher wages, better retirement benefits, and stronger job security, moves that delighted workers but raised red flags for investors. Now, just months later, Ram is slashing prices. Coincidence? Probably not. This may be the result of trying to maintain volume in order to offset labor costs and justify keeping union plants running at capacity. Ram's decision may not have been voluntary. It could have been forced by the economic math. Either they move trucks fast or risk idling expensive union facilities. It's a glimpse into the labor capital tug-of-war that's now shaping product strategy in real time. Ram, like its competitors, has spent the last few years adding massive screens, subscription-based features, over-the-air updates, and digital cockpits to its trucks. But here's the catch. All of that costs money. And worse, it becomes obsolete in 2 to 3 years. What used to be a rugged mechanical machine is now an overpriced tablet on wheels. As software updates age, as infotainment systems lag, and as new features become standard, many consumers are realizing, why am I paying this much for tech that will be outdated before I pay off a loan? RAM's price cuts might be an admission that the tech overload has gone too far, and buyers now care more about